Hello and welcome to Portfolio Matters Weekly Update, Week 80. But before we get into it, Richard will read the disclaimer.
Thank you very much, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Thank you, Richard. Well, before we get going, a bit of housekeeping. We are now entering peak summer season, and next week, Richard, Stewart, and I will all be on holiday, and we are going to take a break. So there will be no Portfolio Matters Weekly Update next week. In the following weeks, I'm afraid the schedule will be very much dependent on who is around. And when I am around, I will try and get something out. But the reality is that the schedule will be disrupted for the summer months and normal service will resume in September. We will keep you updated on the Discord. Okay, lots of news this week. First of all, Libya has reached a political settlement which will allow full resumption of oil exports, and that should add around 500,000 barrels a day to the market. That's good news, should bring oil prices down. Gazprom has resumed gas flows through Nord Stream 1, but they're running at the pre-maintenance level, so far below capacity. And overall, Russian gas flows to Europe are running at between 30 and 40% of normal levels, so far below normal. UK inflation numbers came out at 9.4%, up on the previous month, but core was down. RPI only rose by 0.1%. So signs in the UK that inflation may be peaking. And the Bank of England has pre-warned that it may raise interest rates by 0.5% in its next meeting in early August. In the Eurozone, the big news was the ECB raised rates by 0.5%, which was unexpected. But Italy is now in political turmoil. Mario Draghi has resigned for the second time in a week, and this time his resignation was accepted. And it seems that Italy is likely to have early elections, and the far-right party is the favorite to win. So Italy, as you'll see as we go through this, is likely to be one of the countries most affected by the coming energy crisis in Europe. So what is the ECB's plan for anti-fragmentation? Will it work? So these are the interest rates of various central banks, and you'll see that the ECB has raised rates for the first time in 5 years.
So with the ECB anti-fragmentation plan, I was reading in the FT this morning that the ECB has the mandate to make its own decisions as to which countries' bonds it will buy, and it will buy them on the basis that the price at which the bonds are trading is not reflective of the underlying financial situation of the country. In other words, basically it can do what it likes. But the caveat to that is that if it focuses on, let's say, Italy, which has a very large bond market, other ECB countries will be very unhappy that they're not being favoured in the same way as Italy is. So I think it's a very narrow path to tread. And also, the ECB balance sheet is currently at 9 trillion, and this effectively will be more QE.
Well, exactly. They can buy Italian bonds, and this is essentially, as you're saying, it's largely a political decision, not necessarily a market or economic one. I mean, who decides what a normal market rate is? The ECB does. Exactly. So, but if they're going to buy unlimited numbers of Italian bonds, I mean, where are they going to get the money from? If they're printing it, how is that compatible with raising interest rates?
There's complete contradiction, Keith. It's a papering over the cracks, smoke and mirrors. I'm sure there are other metaphors.
Yeah. Well, if there's an economic crisis in Italy, and Italy will be the second most affected country in the Eurozone by the energy crisis, and there's a political crisis and potentially an EU unfriendly right-wing government coming in.
Exactly, which would be unpalatable to rescue their bonds.
And there's a great deal of moral hazard in continually bailing out a country with no strictures or conditions attached.
Yeah.
What's to stop the Italians just continually running a huge deficit?
And my final point, I suppose, is that Italy has a debt to GDP ratio of like 130, 140%, doesn't it? Well, what would be the normal price for their bonds to be trading at, given that financial situation? I'd say, in the high single digits or maybe the low teens.
Yeah, good point. Okay, moving on to this week's economic data. So, big data dump this week. We had the US Michigan Consumer Survey, and actually generally okay. So consumer sentiment actually ticked up in July. It's still very poor, but it rose a bit. Inflation expectations came down. So the 1 year inflation expectations fell to 5.2%, still very elevated, but coming down, as did the 5 year inflation expectations. Current conditions substantially beat expectations. Still poor, we'll show you the chart, but a big bounce from June, and the market had been expecting a deterioration. Existing home sales also beat expectations. So the data are portraying a US economy that is weak, but is not currently deteriorating further. In the UK, we had CPI numbers, which rose again, but missed expectations. So the CPI came in at 9.4%, up on May, but below expectations. Core CPI fell. And that's interesting. If we look at producer price inflation, then input inflation was 24% in June, output 16.5%. So that means UK companies should be seeing margin squeezes. But in addition to all that, we had flash PMI numbers for the EU, the UK, and the US. And I'm not going to go through all of these in detail, but pause, take a look. All of them beat. So, and they were all consistent in showing economies that were barely growing, but had a small bounce in July. Now, these are flash numbers, and we're going to go show you the charts cut in a moment. But be aware that because these are flash numbers, the charts are not updated with this data.
It's interesting, Keith. I was listening to a webcast this morning, and the guy was saying that we talk about the US economy with 9% inflation, 7% GDP growth, nominal GDP growth, and he said, "I don't know how you can call a country that has 7% nominal GDP growth in recession, even if real GDP growth is negative." And of course, because he said, the economic activity is growing so fast, and while I disagree with him mathematically, it may be that the business appears to be booming because the nominal GDP is growing quite rapidly. So I was wondering whether that might be a contributory factor to these PMIs beating.
Yeah, if he was right, Richard, Venezuela would have the fastest growing economy in the world, but it doesn't. It's in nominal terms, it's been growing massively. In real terms, it's shrinking.
That's a good point, Keith. I would say that if this is an effect, it's very much a sort of time limited effect, a couple of months until the reality creeps in.
Okay, moving on to some charts, Richard.
Thank you, Keith. So US retail sales, ex gas and autos, showing a positive number there. And US industrial production stabilizing, I would say, at around about 5% year-on-year growth. and consumer sentiment slightly ticking up around about 50%.
Yeah, 50. Still very close to all-time lows, I would say.
Yeah. 1 year inflation expectations just ticking down slightly. And the 5-year inflation expectations, it's very difficult to predict, isn't it? The 5-year inflation expectations 5 years ago would have been about 1.5%.
Yeah, but this is important, Richard, because the Fed will be watching this very closely and will be encouraged.
Yes, that's very true, Keith. And the US, between current conditions, so fairly strong downtrend there with a few sort of counter trend rallies in place, and this might be one of those. We don't know yet. And US Michigan consumer expectation does not look particularly healthy, does it? It's the lowest it's been since 2010.
That looks awful.
US manufacturing PMI does not look good.
Yeah, bear in mind, the latest numbers of all the PMIs are slight upticks, and they're not shown on these charts because they're the flash numbers.
Yeah. And US services PMI, it's the US composite PMI, which is actually, it's no different to the level it was at for 6 years prior to COVID.
Yeah.
US housing starts, too early to say whether there's a trend change. Existing home sales, certainly a fairly dramatic fall in the last couple of months. And initial jobless claims now looks to be establishing an upward trend.
Yes.
And continuing jobless claims has undoubtedly stopped its downtrend. Whether it's going to establish an uptrend, a bit early to say, I think. The UK claimant count is really almost a neutral, isn't it? Looking at this, I mean, it's best a year.
Yeah, I mean, but bear in mind the y-axis, which starts at -20, so we did have a loss. 20,000 jobs created last month.
Yeah. The UK inflation rate just looks really worrying, as actually does core inflation.
Coming down though.
Coming down.
2 months now.
As we commented last week, core inflation is hugely valuable if you're a robot. Doesn't need to eat or drive anyway. Oh, sorry. UK manufacturing PMI not looking particularly healthy, as Keith said. Small beat in the flash one. And UK services PMI just meandering along. UK composite PMI likewise. EU manufacturing PMI does not look great. And EU services PMI, tricky to say where it's going. And as a composite. The EU current account balance has swung into deficit, apart from COVID, for the first time since the early 20s, if that makes sense. And that indicates that their exports have fallen dramatically, or their imports have significantly risen. Do you have a feel for why this is, Keith?
Well, I think it's almost entirely due to energy. Yeah, so energy prices have shot through the roof.
Energy importation.
Yeah.
Yeah. And EU consumer confidence is in a pretty poor place.
To be fair, it's always in a poor place. It has never reached zero. So, but even so, they're more miserable than usual.
Yes. So, as we discussed, the flash PMIs are showing some upticks. The monthlies are showing poor general trends, certainly in manufacturing. The US is still hasn't fallen away. The economy hasn't fallen away, and we still have to wait and see what happens there. And UK inflation, well, I would say it may be peaking. I am concerned about wage price spiral now. There's a lot of pay pressure in the system. And also what we may find is that the commodity-driven, the energy-driven part of inflation has peaked, but now we're going to get other drivers of inflation coming through as a consequence of that initial burst of inflation.
Well, I agree with you about the wages, Richard. We're now going to see a summer of strikes. and the government, how much is it going to raise public sector pay? Previously, it was talking about 2%. It's now talking about 5%. Let's see. Okay, moving on to one chart. And this week, the energy crisis is not just in Europe. If you look at the chart at the bottom left, that is coal prices from Australia. So China, big importer of coal, they're seeing their energy prices rise. Spot LNG prices, the bottom right chart, again, very high because Northern Europe is outbidding Asia for LNG supplies. And if you pause and have a read, you'll see that a lot of the countries in Asia are suffering severe energy crises. So in Bangladesh, you have energy rationing and demand curbs. In Pakistan, you have power blackouts and load shedding. This is not just a European energy crisis. The way to look at this is that over the last 5 years, there has been very little investment in the energy system, and we've come out of recession, and there's been a surge in demand for power as the world economy recovers, and there's not enough hydrocarbons to fulfill that demand. In addition, Russia has cut its exports of gas and of coal to the EU, and as a result, the world is suffering an energy shock. So, in summary, this winter, the world is going to suffer from tight energy markets, and the US and other energy exporters, so the US is essentially energy neutral, but energy exporters are well placed to weather this. So we're talking about Canada, Norway, and Saudi Arabia, etc., whereas energy importers, such as Germany, can be expected to suffer. Okay, on to inflation watch. Richard.
Thank you, Keith. So as we've seen, UK inflation in June, 9.5%, US 9.1%, and the EU 8.6%. Germany's fell a little bit, 7.6%, and Japan 2.4%. If you look at a chart of Japanese inflation over the last 20 years, mostly it's been deflation, and a spike of 2.4% is roughly in line with other spikes that they've had over the last couple of decades. So for Japan, 2.4% inflation is high.
Yeah, I was surprised that the Japanese number came down last month, I have to say.
They import an awful lot of fossil fuels, don't they? Particularly when having shut down many of their nuclear power stations after Fukushima.
Yeah, I would also point out that most of the core numbers are now coming down. So we're seeing headline inflation still rising, but core CPI coming down in most countries. The other thing I'd highlight is in Europe, the ECB's raised rates, but I believe is still doing QE. And I've been looking at the ECB balance sheet, it's still rising. And this anti-fragmentation plan is likely to involve net bond purchases. So you are taking away with one hand and giving with the other. So I don't know how that works.
Well, I think they are going to finish an asset purchasing program shortly, presumably, unless they start purchasing Italian, etc., bonds, and then they will be re-implementing it.
Yeah, well, exactly. That's my expectation.
They can't not actually implement it because the peripheral European bonds will just start to go up unsustainably.
Yeah.
But of course, they can't do it either because that will cause inflation.
Yeah.
So this is a chart showing that my conspiracy theory was not actually a conspiracy theory, and CPI has been manipulated in the calculation. Can I just divert? So I think the term conspiracy theory was invented by the CIA to debunk people who understood what was really going on, but the CIA didn't wish for it to be known. So they created a derogatory, what is effectively a derogatory title to people who come up with ideas that counter to what the CIA wanted them to believe. Whether that's true or not, I don't know, but that is what I read.
So what this chart is showing is if you use the current inflation measures, then inflation back in the 1970s would have been lower than reported, i.e., the new calculation method produces a much more politically acceptable number than the old calculation method. Now, the old calculation method, actually, we don't need to go into this, but it used to be arithmetic rather than geometric. And that means that essentially the new inflation measure assumes that you're going to substitute your consumption basket for cheaper goods. So if Swedes get cheaper than carrots, you'll start buying Swedes. So the old calculation method used to be your preferred consumption basket. The new method is your actual consumption basket.
What you can afford given
Yes.
the high rate of inflation.
Precisely, yeah.
This is another one of those famous inflation forecasting charts produced by Deutsche Bank, where they forecast US inflation is at or near peak, and then it will fall rapidly at approximately 90 degrees to the previous curve, the previous line. And well, there you saw it here second, actually. And we believe Deutsche Bank are on the ball when it comes to inflation forecasting. It'll be interesting to see what the inflation forecast was 2 years ago.
Yeah.
Not
I think we know, Richard.
Yes. The ECB is forecasting a similar pattern, but actually they've sharpened their protractor. So it's looking at about 140 degrees by eye, as opposed to the traditional 90 degrees. Clearly, there's been a paper on inflation economics that has said 90 degrees is an inappropriate angle to use for the projected line.
Well, at some stage, they're going to be right. But, frankly, I think over the course of the last year, every single one of their charts would have looked like this, but peaking at a lower level.
Yeah.
This is really interesting, and it shows that recessions cause big drops in inflation. So this table shows all the recessions in US history and the CPI ahead of the recession and the low during the recession. So you see the recession in every case causes a big drop in inflation. So if we look at, let's say, 1974, CPI before the recession peaked at 12.3% and then hit a low of 4.9%. In 81, 14.8% and hit a low of 2.5%. So the column on the right shows the peak to trough drop in inflation. So recession definitely causes a drop in inflation. But this chart shows PCE inflation at the peak of the business cycle going into the recessions and then 2 years later. What you see is that 2 years later, as the economy comes out of recession, inflation remained high. So in 1980, before this recession, it was 8.6%. 2 years later, it was 6.2%. So when you get these inflationary surges, yes, recessions cause a drop in inflation, but the underlying causes of inflation remain in place. And when the economy recovers, inflation recovers with it. And then you get a great deal of economic and financial volatility. And that's what I'm expecting.
Yeah, that's very interesting, Keith. And basically what it means is that those inflation expectations that suggest everything is going to drop back to normal in inverted commas of 2%-ish are probably wrong.
Yes, I agree with that. In particular, Richard, we have done nothing to solve the energy crisis.
No.
So I expect as soon as the world economy starts recovering, oil prices, coal prices haven't come down, but oil prices will go back through the roof.
Yeah. So this chart shows that the inflationary impulse from oil is now fading. So you've got the light blue line US headline CPI, and which follows the oil price quite closely, actually, and has done so for quite a long period of time. So it's a genuine relationship. The black line, the price of WTI, and clearly, if US inflation headline CPI continues to follow the year-on-year change in crude, then we are looking at a significant fall in inflation if oil prices don't start to rise again. And the wages of low-paid workers are rising much faster than those high-paid workers, which is actually what the economy should be achieving in any event, in my view, for social equality purposes. And I think, however, in the US, the low-paid workers have missed out for so long that it would require many years of this sort of differential to bring the differential to the absolute pay differential to what it was, let's say, 30 years ago. And rents are still rising. I think rents will continue to rise because they're very much the way they're measured is very much a lagging indicator on house price rises. And supply chain woes are easing. I think the backlogs are also easing, aren't they? And China's opened up its Shanghai and so forth after not doing Shanghai.
Well, that should all be good for commodity and goods inflation.
Yeah. So this is showing what elements of a basket of consumables and services are having the highest level of inflation, and it's perfectly obvious that the biggest element is gasoline, followed by things that effectively use fossil fuels to a great extent. And then down at the bottom, interestingly, I mean, US education has been on a very high rate of inflation for many years, I believe, and now it's just showing 2.7% change year on year, which suggests that if educational establishments are feeling a bit of a squeeze.
Well, I think actually US educational inflation has now caused demand destruction.
Yeah.
So students are being put off by the high cost. The other thing I'd highlight, Richard, is at number 5 in the list, number 6, food at home. Not good. Seeing, food at restaurants, food at home is seeing high levels of inflation. And this just reiterates that point. You're seeing very high levels of food inflation. Eggs up 33% year on year, flour up 20%. This is going to affect US consumers, particularly the poor.
So in summary, UK headline inflation has risen to 9.5%, which is really uncomfortable. And in most countries, core inflation seems to be declining at present. Energy inflation falling. But as Keith rightly points out, one, it has a big input into inflation in other areas of the economy, but also should the economic growth start to pick up again at some point, there is insufficient energy to go around, and we might just start this cycle all over again. But for now, the peak of inflation may be in sight. So let's move on to a recession watch. So Bank of America is now forecasting US GDP growth will be negative throughout 2022, US real GDP. And that does mean they're forecasting a recession.
Yeah.
Negative GDP growth for 2 consecutive quarters or more. So they are forecasting a recession. And the US Empire State Manufacturing new orders view 6 months ahead at a relatively very low level, and hasn't shown any signs of improvement over the last couple of months. So I think that there is a serious risk that the US economy does go into a fairly significant recession, and US consumers are feeling very stretched. This is how they feel in comparison to how they felt a year ago. They're as low as they were around the time of the GFC, and lower than they've been apart from that period for 30 years. Using US housing activity index, so the construction activity basically leads by 6 months, which is what you'd expect, and construction activity has fallen off a cliff. In fact, the cliff it's fallen off is greater than the cliff it fell off in 2006-07. And that is a poor indicator for the health of the US economy going forwards.
Yeah, I had a long conversation with one of our US viewers this week, and we were talking about the prospects for the American economy. And he was saying that he was expecting a shallow recession. And I was reminding him that the sectors that matter are manufacturing and housing, and they lead the US economy. And in particular, we did a whole podcast on this, that they're the only sectors that shed jobs. And although they're a small part of the economy, they're very volatile. And This downturn in housing activity will lead to job losses in construction, and that is one of the main causes of recession. So the sharp downturn is a harbinger.
And this chart shows that global growth optimism is at an all-time low, and it's a Bank of America Global Fund Manager survey. And so people who are involved in the financial markets every day.
And in Europe, credit conditions are tightening. So the chart on the left shows bank business loan standards, and banks are raising their loan standards to cut credit, and demand is simultaneously falling. So that indicates that you're going to see a credit crunch in Europe, which will add to the recessionary pressures.
And of course, one of the things that has enabled the world economy to grow so rapidly over the last 20 to 30 years is the vast increase in debt levels. And when those debt levels fall, the obverse happens and economies contract.
Yeah.
So what's our conclusion? Well, apart from the OECD, a global recession is now probably the consensus forecast. So in terms of what we should be doing in our portfolios, we're saying, we don't say this, but this is a well-known mantra that is very difficult to follow, but it's very important to remember. Trading is 80% waiting, 10% entry, 10% exit. In other words, you have to be patient. You mustn't act impulsively. And I like that last bit. Think like a predator, not like the prey, which is you want other people's money. You don't want to give your money to other people.
So bottom line, we expect a recession is developing. We just need to wait for it to occur. Make sure your portfolio is orientated towards defensive assets, and don't get carried away by bear market bounces in low liquidity summer conditions.
And do not think that you have missed your opportunity, because you probably won't.
Okay, thank you, Richard. Right, moving on to the European energy crisis. Now, I did a podcast on this during the week. So these are gas flows into Europe from various sources. And you'll see the dark blue at the bottom is Russia. And Norway is the light blue. LNG is the mid blue. And despite increased LNG imports, overall gas flows into Europe have fallen very substantially, and that is the cause of the coming gas crisis, energy crisis. Now, if we look at Russian flows themselves, so this has not been updated for the last couple of days. And you'll see that the dark gray at the bottom is flows through Nord Stream, and Nord Stream was closed for 10 days of maintenance, but has just come back on. But it's come back on at its levels earlier in June, and therefore Russian gas flows should go back to the levels indicated by the yellow bar, i.e. about a third of normal levels. And Russia has this energy weapon. It has Europe over the barrel, but the longer it delays using it, the more time Europe has to find alternative sources. So Russia can be expected to use their energy weapon, I think, this winter when their leverage is at the maximum. So what is to stop Russia cutting gas off in October, November? And as a result of the falls in Russian gas supplies starting in June, and particularly the cessation of gas flows through Nord Stream for 10 days, Europe has actually been drawing down its gas storage. And you'll see the effect here, not good, now well behind the schedule to refill gas storage levels. But Russia has been making absolutely massive amounts of money from European energy purchases as the gas prices have gone up. And we've had discussions on the Discord about, Russia not being able to afford cutting Europe off from gas completely. Well, it can. It's made so much money that it could afford to go without exports for a year and it would still be up.
It's also building a gas pipeline to China, but apparently that's going to take 2 years to construct. So they are putting in place plans to cease exporting basically to Europe, but clearly that's going to take a while to implement.
Yes, well, that's entirely rational because the EU is saying they're going to stop importing gas from Russia. So one effect of the fall in gas supplies is that electricity prices are going through the roof. This is this is German 1 year forward electricity prices, and essentially the market is expecting the energy crisis to last.
I would say, Keith, and we've talked about this is wholly contradictory to the inflation forecast, isn't it? Where we know that one of the biggest drivers of inflation is energy costs.
That's true, but these are 1 year forward, Richard. So maybe it hasn't fed through yet. But you're right, we could be seeing a stagflationary period.
Yeah.
Now, this is the daily German baseload power for futures contract. And this should account for the resumption of Nord Stream gas flows. And the latest data is as of this morning. And you'll see it's not coming down. So the market is very concerned about gas flows and a coming crisis. And these prices are going to feed right into German industry and European industry. And this is the forecast UK household energy cap. And it's revised every 6 months. You'll see that at the start of the year, it was £1,300. In April, it rose to the best part of 2,000. And in October, it's forecast to rise to 3,300.
Which is a tripling on what it was 2 years ago.
Yeah. So the energy crisis is not going to just affect continental Europe. It will affect the UK. This will have big effects on household budgets. Households will need to cut back on other expenditure. The current heat wave in Europe is having knock-on effects on energy production. So this is the water level in the Rhine. And the pink line is 2022, and the average is the black line. You'll see water levels are low and falling. And that means that barges are having difficulties getting upriver. And that's important because a lot of coal comes into Europe by barge. And if you look at coal stocks, they are rising in Amsterdam and Rotterdam because they can't get supplies upriver at the usual rate. In addition, France gains most of its energy, over 50%, from nuclear. And those nuclear power stations require water from the rivers. And if the river levels drop too much, the nuclear power stations have to shut down. So climate change is also having an effect on power generation.
That's really interesting, Keith. And this is a personal story. When we went to the south of France this year, stayed in somewhere where they actually get their water, their fresh water, from an aquifer. And for the first time ever, the aquifer was draining dry after 4 hours of pumping, and that had never happened to them previously. And as we drove through France, you could see vast amounts of water being used to irrigate agricultural land, which I presume much of comes from aquifers. And not only is this going to affect energy, but it could start to severely affect agricultural production. It would limit the amount of water that can be put on, maybe not this year, but if this weather pattern holds for the next 2 or 3 years, you could find significant problems in irrigating agricultural land.
Very good point. And as Richard's just been talking about, water levels are low, and we get 14% of European electricity from hydro, which is also going to be affected and falling. But the good news is that actually solar generation has been really good in the heat wave. And I was actually very impressed by the UK because I didn't think we had that much solar. But, on Tuesday, which was the hottest day of the heat wave, at 12:10, we were getting 18.6% of our electricity from solar. I was actually quite impressed.
That is impressive. And I noticed 15% from wind. So in total from renewables, as it says there, 35%.
Yeah. Although, a lot of it was still coming from gas.
Yeah, and also it's very unusual weather.
Yeah. But, there wasn't much wind. When the wind blows, we do generate, up to 30% of our energy from wind.
Yeah.
Various people are coming out with forecasts for the impact of the energy crisis on European GDP, and all the estimates seem quite low to me.
So I suspect that the European Commission is not going to say to Putin, if you cut off our gas supply, we're all, effed. So go ahead and do it, because it's only going to make a 1% difference or something like that. I suspect this is all about propaganda. And the Keith is absolutely right. It would be much, much bigger in reality.
Very good point. But the impact will be very strongly asymmetric. You see, these are the countries that will be most affected. See, Hungary is the worst. Number 2 is Italy. And Italy has debts of 150% of GDP and rising bond yields and no government. All the elements were in place for a Eurozone crisis.
And also not only no government, Keith, but the prospect of a fairly far right-wing government.
Yeah, that's anti-EU.
Yeah.
And the debts of European power companies have grown enormously, and they are now experiencing financial difficulties. The German power company Uniper is having to be bailed out, and that could morph into a financial crisis. All the companies that are being stressed by high energy costs and an incipient recession, when they start to default, they'll place stresses on the banking system. This is the credit default swap on Credit Suisse, and it's continuing to rise and is now at its highest levels since the great financial crisis. So the market is worried about European banks. We've talked previously about how the energy crisis is bad for the euro. And what I thought was interesting is if you look at speculative positioning in the euro, there really isn't any. Look at the black line. That's net speculative positioning in the euro. Left-hand chart is essentially near zero. So if speculators start to become worried about A, the Eurozone crisis, and B, the energy crisis, then the fall in the euro could get a lot worse. So in conclusion, Russia has resumed gas exports via Nord Stream. Now, last week we were concerned that they were going to cut off gas supplies through Nord Stream entirely. That's not happened. Instead, what they've done is they've resumed at their pre-maintenance rate, which is still well down on normal. All the elements are still in place for very elevated energy prices this winter and an energy crisis.
So now we're going to do a little piece on the emerging market debt crisis, and even the emerging market debt crisis. So what are the causes of disruption in emerging market economies? High food price inflation, high energy prices, and the rising US dollar. Of course, the rising US dollar effectively aggravates food price inflation and energy price inflation. And over 400 billion of emerging market debt is trading at a spread of over 10 percentage points higher than US treasuries, which is a lot. That puts it around about, let's say, 11 to 13%, depending on, which is a high, given that they would have borrowed probably at half that, I would think, Keith.
Yeah, well, it's just totally unsustainable. They're essentially locked out of financial markets at those spreads. Also,
again, in today's FT, there was an article about Chinese exposure to emerging markets through the Belt and Road. And they have lent, as we know, they've lent large sums of money for major infrastructure projects in emerging market countries. And a lot of those countries are now unable to service that debt, which clearly puts pressure on the Chinese financial system, because it's quite a substantial sum of money. These are the countries who have bond spreads greater than 10% over the US Treasuries, and there's a lot of them. And let's not talk about the Ukraine, because that is a bit of a special case. But if you look at Sri Lanka, for example, which has a lot of social unrest at the moment, we've been reading about. So if you look at Sri Lanka, for example, that's showing a 68% spread over US Treasuries. Nigeria is 12%. Egypt's at 12%. Argentina's at 27%. You know, there's a lot of significant debtor nations who are effectively in default. This is showing the percentage of tax revenues spent on debt repayments. And you know, this would have been probably a quarter of these numbers a year ago.
And a lot of this looks unsustainable. You know, Egypt paying 44% of tax revenues on interest rate payments.
Particularly when it's going to have to subsidize food imports, food prices, wheat, and so forth. And this is a chart of Egypt's foreign reserves. So the the actual reserves falling quite rapidly. They've fallen in the last year and a half or so. They've fallen probably by 30 to 40%. And as a share of GDP, they're also fallen about 50%. The pricing of the collateralized default swaps is suggesting that they will go into, they are more likely than not to go into default this year. Kenya's falling government bonds, I mean, they're on their way to not very much, one would imagine. And a record number of emerging market countries are trading at distressed debt levels. So we're now looking at 16, and you know, basically in the last 2 years, there has been this emerging crisis, and the parabolic nature of that count chart is not looking optimistic for the next 12 months or so. Absolutely.
So this shows the change in FX rates by country versus the US dollar over the year to date. The Russian ruble has appreciated massively. Essentially, it's still getting loads of foreign currency inflows as people buy Russian energy, but sanctions mean it can't spend it. So its net balance of payments has turned hugely positive. What I found really interesting was that European currencies are trading like emerging markets. So at the bottom here, the worst performer this year was the Turkish lira, which has enormous inflation. Then we have Hungarian forint, Argentinian peso, but then the yen. The yen has the fourth worst performing currency. And if we look at the pound and the euro, they are actually doing a lot worse than some emerging market currencies, such as the Colombian peso or the Thai baht.
So our conclusion is that all the elements are in place for an emerging market debt crisis, and avoid emerging markets, be it equity or debt, until this is resolved.
Okay, thank you, Richard. Moving on. Right, so this is the single best predictor of equity returns, but I should warn you, this is a really long-term chart, and it is not useful on a short-term basis, but it is useful as a long-term asset allocation signal. So what it shows is the red line is the average investor equity allocation, and the blue line is the subsequent 10-year S&P 500 total return. You'll see there's an incredibly good link. Now, what's interesting is this original article was from 2013. So we can actually see how it did over the following 9 years. Answer, really well, actually. If we now look at what it's predicting, see the red line is very high. So investors have a very high allocation to equities, and that means future returns over the next 10 years will be very poor. They're forecasting -3%. So be aware, careful about holding equities. Obviously, our regular viewers will know that we're expecting recession and equities seem incredibly overvalued, and we've been warning about this for a while. But this indicator, which if you're interested, the original article on philosophical economics is very long, but really interesting, and dig it out and have a read. And thank you to our Discord member, Spider786, for sending us all this. And actually, this data is updated on the St. Louis Fed website, which is amazing. So you can have a look every month, and it has come back down a little bit since that chart we showed you, but still very elevated and indicating that over the next 10 years, the S&P 500 is unlikely to do very well. So in summary, I think this is a really interesting predictor of long-term returns, and we will be covering it on a fairly regular basis. Okay, onto other charts, Richard. So this shows the moves in FX markets and the real effective exchange rate of the US dollar, which has increased by 26% since 2010. But what's really interesting is Japan. It's seen a massive devaluation. Essentially, the real exchange rate has fallen by 42% since 2010. It's
Wow.
accelerating downwards.
And even with that loss of purchasing power, they've had very low rates of inflation.
Yeah, absolutely amazing.
So is there a financial crisis in China? So what appears to be happening in China is that traditionally, if you can call it a tradition, because it's only a few years long, but consumers who wish to buy a residential property in China, would take out a loan and pay for the property in its entirety off plan. The developer would then use that money to build the property out and obviously take its profit from that. But what is happening now is that people who have taken out mortgages to purchase property off plan, who don't have a property because property companies have got into great difficulties, are stopping paying their mortgages. That means that the developers have no money and can't pay their suppliers, and they're not paying their suppliers, and their suppliers have no money and they're not paying their suppliers. So we have this cascade effect that basically the whole of the property sector is being starved of cash, and the people at the top of this cash stream, the purchaser, the consumer of the property, is not getting their property built. And given the size of the Chinese property market, this is potentially a huge problem that the government will really struggle to control.
So last week, we were talking about the banking crisis in Hainan province, where one of the banks had failed and essentially depositors were lining up trying to get their money back and being attacked by thugs. And we wondered why the Chinese weren't bailing out this small regional bank. Well, this week it got worse. So the Chinese have now sent in the tanks to physically prevent depositors from getting into the banks. And the bank itself has told depositors that their money is no longer in cash. It is in an investment product which they can't withdraw. Now, if you think about the early days of banking before there were central banks, then this would happen. Depositors would be unable to get their money out of a bank because it failed, and that would lead to a bank run. And that bank run would then spread to other banks and cause a systemic crisis. And that's why the Fed was instigated after the panic of 1907. And in China, if you have your deposits in a small regional bank, presumably now you are thinking, I'd better get that money out. And all the conditions are in place in China for a financial crisis, one that has been long predicted, but may finally be arriving.
And of course, the ploy of putting tanks outside banks to stop people from withdrawing their money and then saying it's unavailable doesn't work. It just shifts the problem elsewhere in the financial system.
well, it's going to undermine all confidence in the financial system.
So the answer to the question is yes. There is a financial crisis building in the Chinese financial system, undoubtedly. So moving on to our weekly checklists, we have the equity markets. So pretty good week for the equity markets, actually bounced. And obviously they've had a pretty bad year mostly, but they've had a good bounce this week. The FTSE up 3.4% and stocks Europe up 4.4%, the S&P up 5.5%, and Nasdaq up 7%. Nasdaq still down 23% on the year. The Hang Seng up 1.5%, and Topix up 3.5%. Topix actually almost unchanged, which, if you look at it in real terms, the currency's suffered something like a 20 to 30% decline in the last 6 months. So in real terms, if you're an overseas investor, you have lost quite a large chunk of money in the Topix. Bitcoin was up 11%, only half the year, and the pound a little bit up and down 11, nearly 12% for the year. Dollar index down a bit, but still up 12% for the year.
I'm reminded, Richard, that last week we showed the seasonality chart, and we're entering the volatile summer months when things fly around on low liquidity. So yeah. I think that's exactly what you're seeing. Sentiment was overly stretched to the downside, and we've had a bounce. It does not mean we're seeing the start of a new bull market.
Completely agree, Keith. The S&P 500 upward revisions of earnings forecasts. Normally they're only ever upwards. And this is showing that the number of upwards revisions is only 33%, as opposed to what it was a year ago, where it was 80%. So analysts are starting to expect earnings to fall, but they will not nail their colours to the mast and say that.
So we've had a really extraordinary couple of years in the equity markets, where essentially we've gone through a whole cycle in 2 years. During the pandemic, there was massive switching out of cyclicals to defensives, and then it bottomed in March and people switched back into cyclicals. And then we've had a really short cycle of under 2 years, 18 months, in fact. And then now investors have switched out of cyclicals and back into defensives in the last few months. So we're expecting, as we go into recession, that cyclicals will continue to underperform, and then at some stage the economy will bottom and you need to switch back in. Now, generally, this cycle lasts for 5 years, but we're seeing it compressed into 18 months.
So a traditional leading indicator, the transport sector, is suggesting that things coming down the road are not great. So it's declined substantially since April, and it's not looking a happy chart there. So the reason the transport is a leading indicator of boom times to come if it starts to go up is because, of course, as the economy becomes more active, transport is more in demand, so the transport sector does well.
So what are the crayons showing here, Richard? Is broken out of is that triangle pattern?
Yeah, it is, isn't it? It's not. It's broken out. Yeah, I mean, I guess you'd say it's broken out of it to the downside, wouldn't you? I'm not convinced either, Keith. It doesn't look healthy, though. I'm convinced of that. So the question that is being posed here is: are analysts mentally retarded? And the reason we're posing the question is because the earnings revisions are hugely positive. The year-to-date is that's a red line that finishes in July. And they're in line with the earnings revisions of, if I can get my colours right, 2021, which were extremely positive. Basically, analysts are saying earnings revisions are going to be as healthy this year as next year, or rather, earnings growth is going to be as healthy this year as it was last year.
Yeah.
And the well, we suspect they're wrong.
Well, the European economy is slowing rapidly. We're going into an energy crisis. Seems absolutely absurd to me.
And in a crash, all correlations go to 1. So which means that nothing you own is safe in a crash.
So this is interesting, and it shows the massive turnaround in investor flows in different sectors. So earlier in the year, we saw very strong performance from the energy sector. And then in April, things turned around and you saw net outflows of energy ETFs and net outflows from financial ETFs and net inflows back into tech. So it's like the US investors have not got over the tech trade. As tech has come right back down, they're kind of bottom fishing idiotically.
They're waiting for it to bounce back up to a new all-time high, I think, aren't they? And they're scared they're going to miss the boat, so they're jumping back in. And I think the boat isn't coming back for quite a long time, personally.
Yeah, I agree.
Tech was meant to be a secular growth story, i.e., it will continue. It will continue throughout the economic cycle to perform well, but it hasn't. It's proved itself to be very, very cyclical indeed, as we have seen with the substantial falls in the ARC ETFs.
Yeah, and these are tech has suffered the worst downgrades of any sector. It's meant to be a secular growth story. It's proved to be incredibly cyclical.
And punters are abandoning leveraged ETFs. Those of you who've been watching us for a while will saw that we did a little podcast on leveraged ETFs probably over a year ago now. And basically, if you buy and hold a leveraged ETF and the price of the underlying stocks goes nowhere, you will lose all your money in due course. They are very dangerous things, and punters are abandoning them because they can lose a great deal of money very quickly in a leveraged ETF. Very sensibly too, I might say.
Well, up to a point, Richard, because they're piled into leverage short ETFs instead. So, and frankly, punters are really rubbish at this. The last time they piled into leverage short ETFs was at the bottom of the pandemic, and the market promptly rallied hard. So, frankly, I think this is a negative indicator, and you'd expect that. Frankly, when I look at this, I expect a strong bear market rally to bankrupt them all.
Yeah.
Okay, moving on to commodities. Thank you, Richard. So this is really interesting, and it shows that during recessions, which are caused by commodity price rises, commodities tend to continue rising throughout the recession. So if you look at the recessions of 1973, 1980, and 1990, all of which were caused in part by strong rises in commodities, then commodity prices continued to rise during the recession. And this time round, again, we are having a recession which is partly at least caused by energy price rises. And if that correlation were to hold, you could see commodities continuing to do well throughout the recession. Now, that does not mean commodity equities do well. Did a whole podcast on this. 1973, 74, oil prices remained elevated. Oil companies, the oil majors, had record profits. Their share prices fell. I would turn to the chart we showed you earlier. In a bear market, all correlations go to one. Everything gets sold off. And moving on to energy commodities. So Brent had a bounce, but WTI didn't. So American oil prices fell by 0.4%. Brent rose by 3.7%. Dutch natural gas futures fell by 6.5%, but remained very elevated. US natural gas futures rose by 17%. Remember, they had fallen off hard after an explosion at an LNG liquefaction plant, and they're now recovering. Coal down 2.8% on the week, but still up 140% on the year. Uranium up 0.5% on the week, up 8% year to date. Turning to numbers relevant to the oil market, well, US crude inventories in total fell by 3.9 million barrels this week. Remember, last week there was a huge build. Excluding the Strategic Petroleum Reserve in the US, private markets inventories rose by 1.2 million barrels. So releases from the SPR were more than adequate to fully supply private markets. US oil production in total fell by 100,000 barrels last week. We are now in maintenance season in the Gulf of Mexico, and the rig count rose by 2. Now, in my conversation with our American viewer, he was discussing the Halliburton results. So Halliburton are a US oil services company, and essentially they reported that they couldn't increase production because they had not invested in new equipment during the downturn, and that all their equipment was now rented out into 2023.
Oh.
So they reported good revenues and rising margins, but they couldn't increase revenues apart from increasing prices because all their equipment was rented out. And that has implications for US oil production. Essentially, you're running up against hard constraints. There's no more equipment. So this is crude, Brent. It appears to have ceased rising. These are Russian oil exports by sea, and having held up well, they're now coming off. This is really interesting. US gasoline demand, 4-week average, is down during peak driving season. So evidence of demand destruction in the US, although this is in a longer term perspective and small tick down. But if we look at gasoline demand relative to historic averages, I mean, really quite interesting, quite big drop compared to normal. But gasoline prices in the US appear to be coming down as the oil prices has peaked. And I thought this was really interesting and useful. So if you look at the bottom chart on the right, this is total US oil inventories. And we now have 2 months data in which inventories have stopped falling. So that means the US in total is well supplied. So that is not bullish for oil prices. Now, the other thing that happened this week was that Saudi Arabia published a plan to raise output to 13 million barrels a day by 2027. Now, previously, it had claimed to be able to produce 15 million and to have current capacity of 12.5. Essentially, it's got nowhere near that. It's currently pumping at full capacity, and it's 10.5 million barrels, nowhere near 12. So there is, as we discussed previously on the weekly many months ago, there's nowhere near as much spare capacity in OPEC as they claim. And this is the long-term forecast for Saudi oil production based on an analysis of their fields and the plans to bring those fields into production. You see that forecasting that Saudi production will peak within the next decade and then go into permanent decline. Dutch natural gas futures, very elevated. And these are European gas stocks, which have seen these drawdowns this week.
Yeah.
US natural gas prices bouncing back. Coal prices very elevated. John Kemp of Reuters did chart pack on coal this week. So this is global electricity generation from coal up to last year. And you'll see that it's been continually rising. It's a new high last year. And that is all from Asia. So the white line is coal-fired power generation in Asia, which has been relentlessly rising, whereas it's declined everywhere else. But what's really interesting is global coal production is not increasing. It actually peaked 8 years ago in 2013. So seeing rising coal demand, flat to declining coal production. No wonder the coal price is going through the roof. The good news is if we look at the change in global electricity generation over the last 10 years, you see that actually more wind capacity has been added than coal. And I find that personally very encouraging, although the largest contributor to new electricity generation has been gas. As gas and coal prices have gone through the roof, hopefully that should incentivize a lot of new renewable capacity. Moving on, this is uranium, which is flat. On to industrials, Richard.
Generally, a bit of a mixed week for industrial commodities, some fairly big ups and some fairly big downs. And year to date, they are pretty much down, with the exception of lithium. So aluminium and copper and nickel all had good weeks, as did zinc. But cobalt, iron ore, neodymium, tin, and ferrovanadium had bad weeks. So I'm not quite sure where whether this is indicative of any particular sector coming back into favour. I suspect it's sort of fluctuations in the people's views of where the world economy is going, and so volatile, but not particularly, I think, going anywhere.
Yeah, I think these have to be seen in context of a bounce in all risk assets this week, Richard, and a lot of these had frankly fallen a very long way and looked oversold. I'm going to show that as we go through the charts.
So aluminium, it has fallen very significantly from its peak, and it doesn't look as if it has necessarily finished that decline. Cobalt, likewise. Copper, again, it has a little tick up, but it doesn't look as if it's necessarily reached the bottom. And actually, with the problems we absolutely know we've got in the Chinese property market, and the US property market construction will begin to slow down. With house builders, one would expect to be more rather than less pressure in the short term on the price of copper. With chromium, pretty much unchanged over the last few months. Iron ore, which is showing great volatility, very much exposed to the property sector again. So apologies, I'm having some connection problems here, so I've stopped my video. So lithium seems to have stabilized at that highly elevated level from where it was 2 years ago. Neodymium, difficult to know where it is, and it's certainly not showing strength. Nickel is the most extraordinary chart. It's sort of now at the level at which it took off from that huge short squeeze in the spring. And tin, again, we didn't know why it was going up, and I think we don't really know why it's going down. Ferrovanadium had a little spike, basically, and it's now gone back to the pre-spike level. And zinc, all these charts look very similar, don't they? A large spike up in the early spring, followed by basically a decline to the level before they started to spike. And on precious metals, gold had a reasonably good week, as did silver. Well, they all had a good week, actually. But year to date, apart from rhodium, they're all down or unchanged in the case of palladium. But a better week for precious metals this week than we've had in the last few weeks. So there's gold, silver, platinum, rhodium, and palladium.
Okay, thank you, Richard. On to rates. So yields fell actually in the UK and in the US this week. So the yield curve shifted down by 7 basis points at the short end and by 15 basis points at the long end. So is the market now starting to price in a recession and the peak in inflation? And I find it interesting that yields have actually fallen this week when we are in a risk-on environment and equities rallied. Now, in the periphery of the Eurozone, bond yields did not fall, they rose. So the Greek 10-year rose by 9 basis points and the Italian rose by 17. So this is the Italian 10-year, not yet back to its peaks of earlier in the year before the ECB announced its plans for an anti-fragmentation strategy, details of which we are awaiting. This is Greek. This is the UK 10-year, which has really come off quite sharply. Looks to me a bit overbought currently. This is the US 10-year, which has not come off as much, actually. And reminder of the seasonality chart. We're now in choppy summer trading. Don't get carried away in bear market rallies. So concluding comments. Well, we're in the dog days of summer. Volumes are low. Traders on holiday. Expect lots of volatility on low volumes. So this week we've had a bounce because, frankly, investor sentiment seemed very negative and too negative, and it didn't take much to have a bounce. But developed world economies are weak, and all the medium-term indicators are that the economies will be slowing into an energy crisis this winter. So be wary and don't take too much risk. Now, all eyes are on the ECB. We would like to know what their anti-fragmentation strategy is and how they're going to deal with Italy. So watch this space. Richard, what have you been up to this week?
My change for the very slightly up because of the little tick up in precious metals. So my change for the year is down 0.1%, disappointing, but for all share down 4.2%, so relative performance 4.1. No purchases and no sales. What I have done this week is I put my portfolio into a pie chart, and I haven't got percentages on here, but basically it's about 85% cash and precious metals, and then I have a small amount in gold miners, silver miners, rare earths, and uranium. I have no crypto, but and I have no oil, actually. Having sold the Gulf Keystone that I bought last week and forgotten to put it in my disclaimer, in my activity for this week. Apologies for that. So I'm very much sitting on my hands, and I'm also very much hoping the gold price is going to go up. And we shall see. We shall see. But I'm not inclined to put any more money into the market at the moment until we see where things are going in the autumn, at least. How about you, Keith? How was your week?
Thank you, Richard. Well, I had a bit of a crappy week, actually, down 0.3%. Essentially, I've now put all my money into US dollars, and there's a market rally. So safe havens such as the US dollar sold off. And earlier in the week, I was down a lot more than 0.3%, but long bonds have rallied. So, but I'm still having a good year. I had no sales this week, but I made some purchases. I added duration to my bond portfolio. Now, I have a brokerage account that allows me to buy foreign assets, and there I bought some long dated US bonds. Now, the longest dated US bonds are the 30-year, and I didn't buy the 2052 because it is on run. So it is very actively traded, and that means that the yield is slightly lower, and as it goes off run and people stop trading it as much, the yield rises. So I bought bonds that are already off run, I believe. And these are the details. If you're interested in following me, then the details are on screen. And I will be aiming to add to those over the coming few months. This is my asset allocation as at the start of the week. And you'll see that I have been buying US dollar assets and bonds. I'm expecting a recession, and I've been adding duration. So essentially betting that long bond yields come down as inflation falls, and aiming to be counter-cyclical. And this is my equity allocation. Equity is a very small part of the portfolio now. Now, this is my asset allocation over time. And we were discussing last week how I tend to have quite a binary portfolio, and this is evidence of that. So we have three assets: equities, gold, and bonds. And you see that during the pandemic, I had an allocation to bonds, and which I then cut to zero as I put everything into the equity market and gold. As gold stopped performing and came off, I sold it and had everything in equities. And then earlier this year, I've essentially almost entirely sold out of equities, and I've increased my bond holdings. And these are my bond allocations. And you'll see that currently the vast majority of my holdings are in short-term US Treasury bonds, but I will be switching out of those into longer duration as the recession becomes more certain. And this is the 2051 US Treasury bond. And has it bottomed? I hope so. And this is the other one I bought. Again, has it bottomed? So if the bonds were to go back to where they were at the start of the year, you're looking at least a 20% return. That is my target.
You see your eyes lighting up, Keith.
Yes, exactly. And this is gone.
No, I was going to say, I think I was reading today that, I was listening to this podcast this morning with Harley Bassman, the creator of the MOVE index. This is the bond volatility index. And he was saying he thinks that US bond prices, yields will continue to go up for some time. And I mean, it's very unclear, really, isn't it, where that balance lies at the moment, which is why I guess you're moving into the long duration ones slowly.
Well, that's right. But I mean, there's a great deal of uncertainty. I think that we're heading back into a deflationary environment. So, but there are plenty of people who disagree. Yeah, that's why prices are so low. In the case of the US, buying US bonds, I'm expecting the energy crisis in Europe to be bad for both sterling and the euro. So I think it's safer to buy US bonds than it is to buy the UK ones. But UK long bonds had a very good week, actually. So this is my 2071 gilt, which I bought at 91. It's now well below that. But earlier in the week, it went below 75. It's now above 80. Okay, thank you all for watching. Reminder, we will be taking a break next week, and I'm afraid we will have a disrupted summer schedule, but we will try and get things out when we are around. So in the meantime, it is goodbye from Richard Wheater.
It's goodbye from Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.